G'day there. Welcome to the closing bell on the 30th of April. It's been a pretty volatile week, hasn't it? But if you've been watching these videos, you shouldn't have been too surprised by the big sell-off. We've been tracking the market for this last few weeks. I've been showing you where things have been heading and where I thought they were going to head. And pretty much it's been bang on what's been happening this last week with the US really getting hammered. Now, I record these videos on the Friday, so I don't know what happened in the Friday night session in the US, but you do. And last week I was talking to you the day before the big sell-off that happened on that Friday night, and it's certainly carried on. So I think it's worthwhile checking out some of those key charts that we usually look at, just to give you a sense of the fact that this is now getting pretty interesting, a little bit more downside, and all of a sudden it could actually cause really accelerated selling. It could pick up a notch. So I want to make sure that you know what the state of play is out there at the moment. So let's jump over to the charts. Have a look here at the US 10-year bonds. Again, we've been tracking this closely. I won't go into this for too long. The major thing to note is that 3.25% level, which was the high in 2018 in the US 10-year yields. That's the one for me to watch because we're in the area where the buying should step in. Now, this chart, just quickly, when the yield is going up, the price is going down. And when the yield is going down, the price is going up, because this is a chart of US 10-year bond yields. You can see there the number 2, 2.5, 3, you can see on the side. That's the yield of those bonds. So yeah, the key thing is if this sell-off, and that is rising rates, if the sell-off continues and it busts up through 3.2, I mean, I don't know what's going to happen above there, but I'm just concerned it could accelerate the selling. It really could bust out, because it's a bit of a sign that the multi-decade downtrend in yields is looking under threat. It would be the first time for 30-40 years that we see the lowest high in the downtrend actually breached. So that's been the high in yields for a decade. So that does shoot up through there. I'm just concerned that it really could, at least initially, see a lot of selling, but then you'd think the buying would step in, and who knows. But just want you to be aware that that level is pretty important, and we're not really seeing signs of people stepping up and really buying those bonds in a big way yet. And that will really affect equities if those bonds sell off that sharply. And the next thing I want to move on to is those the US yen. I have been showing that. There's a few things I've been pointing out to you in this last little while, and they're really starting to take shape as I've been expecting. You've got the US yen here. I was showing you that 125 level, which was, again, a multi-decade high in that US yen. So that yen really weakening now. You can see that accelerating the sell-off in the yen and the buying in the US dollar. That's because the Bank of Japan reaffirmed their commitment to keep their rates on the 10-year bonds at 0.25. So as the US rates rise, there's a lot of tension starting to build now. And if the Bank of Japan is going to sit there and buy as many of those bonds as possible, keep rates incredibly low in Japan and buying it with printed money, investors really can, borrow in yen and invest offshore. And perhaps that was part of the spike that we saw in stocks after that announcement from the lows, really kicking off that short squeeze, and the yen really kicking higher, going from around 128 to over 130. So it's going to be interesting to see how far this yen collapses and at what point the Bank of Japan starts to scratch their head and change course. But for now, that yen, there's only one direction for it to go if they're going to force those 10-year yields to stay at 0.25. So that's an area of the market to be aware of. It really is starting to go now. I was telling you about this when it was around 124, and you can see the move that it's had since talking about it with you only a few weeks ago. So that is a flashpoint in the market. And the Aussie dollar, I was also showing you that Aussie dollar a while ago, a few weeks ago, saying that it looked like it was going to sell off. So let's have a look at that. I'm just going to look at the rally over the last year or so and look at that wave. And I was telling you at the time, it was up above 74 cents. So you can see there on that wave, what I'm really looking at is the setup of the range there that you can see, and the series of false breaks you can see there happening over and over, and then that false break again happening. And we got the weekly sell pivot a couple of weeks ago, and it's in the sell zone of that whole wave higher over the last year. So that was a boomer, not a bad call. And now looking pretty interesting for possibly further more downside or more downside to come. So, back below 70 cents, it'll be interesting to see whether the Aussie dollar gets down there, and it certainly hasn't cracked yet, but I'd be concerned what happens below there. So probably a bit of buying support for a while. It may take a few months before it actually does crack below 70 cents, but it'd be looking pretty tragic once it does crack below that level. So looking at some other markets out there that I think are worth just having a quick squiz at so you can understand the state of play is, for example, the NASDAQ. I just want to show you the fact that it has already really created the monthly sell pivot a few months ago, and it is just looking quite weak, even though it's had an amazing run, of course, as you can see. But it is just starting to crack through that 20-month moving average, where we haven't got a monthly change of trend yet, with that 10-month exponential crossing under the 20-month simple. Not quite there yet, but yeah, it's a little bit more downside, and there's not going to be a lot of support. So it had better hold in there now, because below here, it really should start to tip over at a more rapid rate of knots. The Russell 2000 as well. This is more of a general look at the whole US market to get a bit of a sense of what's going on. And that one certainly has started to tip over. We got the monthly sell pivot a few months ago, an attempted rally over the past couple of months, and then falling over again. So again, down through those lows is really cracking beneath that 20-month. And, just going back to 07, you can see once it does that blue line, which is a 20-month simple moving average, once it cracks, there just is a higher risk, especially of at least quite a sharp sell-off, even if it will then bounce. But you can see there, that's nearly a year of selling here. That was a month of very sharp selling. This was the crash in 2020. So it's just one of those setups now where if the selling continues, we really should see quite a sharp wave lower. The immediate attraction would be to the midpoint, down around 1700, currently at 1900. You'd want support to find there, because if it didn't, watch out. It could even have a real tip over all the way down to 12 to 1400. And the monthly trends just about to cross there. So the general market is weaker in the US than the S&P is really letting on. And just jumping to the S&P 500, and this is the one that we were looking at last week. I've been showing you this for a while, this weekly chart, the weekly trend there, 10-week exponential, 20-week simple. It's been a long trend. We've got a shift in trend there. And then we've got the shorter term corrections that I was showing you. I've been tracking this all the way along and pretty much picked every level along the way just by using this methodology of looking at the buy and sell zones of the correction. And you can see there, we've got that rally on the weekly chart, hit the bottom of that sell zone perfectly. We got the weekly sell pivot there. I was chatting to you last week saying, watch out, this is where things can really tip over from here. And I'd say that's been pretty much correct. You're now seeing the buying pressure come in, around the buy zone of that corrective phase from the last few months. So not surprised to see a bit of a squeeze from here. And I'd say just back to the moving averages, but still looking bearish. So I'd be saying up around that 4,400 to 4,450 should see quite stiff selling pressure if this market is weak. And the thing I want you to note is if the low of the whole correction does go, it just opens up the possibility of some pretty stiff selling pressure coming out of the woodwork. So that's sort of a line in the sand for me of the next wave lower in the market. And really it's like the beginning of a downtrend. You can see there, the correction. And then if we have that next leg, it's like, what does happen below that level? That's the question. And, it was a pretty sharp rally, and most of that was hot air created by the Fed, just throwing kitchen sink at the market after the 2020 crash. So, why can't it fall heavier and further than most people think? If we just look at the whole wave higher since the 2020 crash, you can see if it does crack through those lows, really, why can't it head back to that point of control? And that would be down around 3,500 in the S&P, which would also correspond to that old high. So that is a possibility down the track. Now it's not there yet, hasn't broken, and we've got the signs of a short squeeze. So, next week or two could be that short squeeze action. But any bad news, things turn back down. There's already that downside momentum there. So you want to be treading carefully. And if you're feeling you've got too many positions on, you'd probably use the opportunity on the rally to lighten positions a bit. But, there's always opportunities out there in that microcap space. That's sort of where I'm doing a lot of hunting in my microcap trading service. It's just been set up. So check that out if you're interested in trading those little piddlers, or there's always something running in that space. But otherwise, check out my pivot trader, which is a bit more of a conservative one. So that is it for today. Be a bit wary out there. It's looking pretty interesting, certainly panning out as expected at the moment. And I will come back with more next week. All right, cheers.